Chapter 11, Part 3, we're going to look at changes in estimate, error correction, and add-ons for intangible assets. So, what affects depreciation? Well, if there's a change in service years, salvage value, or additions. This is considered a change in estimate and is treated prospectively. You would determine the net book value to the point of the change, and that amount less salvage value is the new depreciable base. A disclosure note should describe the effect of a change in estimate for the current period on net income and related per share amount. So now let's take a look at an example. This example is for add-ons. In this example, we bought a building and we thought it would have a 40-year life, and we paid $2 million for it, and it has a salvage value of $60,000. And then in January of 2010, we added another add-on for $500,000 and $20,000 salvage value, and it had a additional life of 30, which would be the same as the remaining life on the building. But then in 2025, we estimated that it would extend beyond the original estimate by 20 years. So now what does that mean? So let's first calculate the depreciation on the two items. One is the total building, which was 40 years, and that gave us annual depreciation of $48,500, and then the add-on. And there we were able to calculate our depreciation, which is the cost minus the salvage value divided by the service life, gave us $16,000. Next thing we have to do is determine the net book value. So the building is $2 million. We had 25 years of depreciation. We take away the salvage value, so we know we have a depreciable base of $727,500. And we have 35 years left, so we had originally 40, we added 20, 25 have gone by. So that's our new depreciation rate. Now we're going to do the add-on, which 15 years have gone by. We now have a new depreciable base, and we divide by the remaining years. We add those two together, and that's how we get our new annual depreciation. So that would be our journal for our year. Now, what happens if we have errors? Well, if they occur in the current year, then only current year is affected. If it is a prior year correction, it is treated retroactively and may require restatement of financials and adjustments to beginning retained earnings. So let's take a look at an example. All right, we purchased a truck for $18,000 in January with no salvage value and a 6-year life. The truck was sold in 2025 for $3,500, and we had someone that didn't quite know what they were doing, or they got bad directions, so they received the cash and took $3,500 for the truck off the books. Now it's the end of the year and no additional depreciation was taken, but what should have been made? What entry should have been made? Well, we should have figured the accumulated depreciation. We would have gotten cash. We would have taken the accumulated depreciation off the books. We'd have taken the truck off the books, and we would have shown a loss of $2,500. Now that's what the entry should have looked like. Now, you have two ways you can correct this. The best way to do it would be to reverse the incorrect entry and make the correct, or to adjust the difference. But I would say do the other one because you leave a better trail. And when you're asked 10 years later what you were doing, you're not going to remember. All right, so now what happens if we have an error that affects prior years? So in this case, 2025, it's discovered that equipment purchased on January 1st of 2022 for $200,000 with a 5-year life and no residual value was debited to an expense account. So what is the effect on the earnings through 2024? Because this would require a prior period adjustment. So we had expenses shown in 2022 of $200,000, and what they should have shown is $40,000, and then for the other years, it should have shown $40,000 a year. So, over the 3-year period, depreciation was understated by 120 and other expenses were overstated by 200,000. So, how do we correct this? Well, we would put the equipment on the books, put the accumulated depreciation on the books, adjust retained earnings for the difference that was booked as an expense that shouldn't have been. And that ends this presentation.